Options Trading for Beginners and Dummies. Written by Giovanni Rigters. Narrated by Christopher C. Kelly. Welcome to Options Trading for Beginners and Dummies. In this audiobook, we'll introduce you to the exciting and challenging world of options. While options involve higher risk-taking than normal stock market investing, they are also more interesting and exciting, with a huge potential upside. Options are a less well-known aspect of the stock market that traders can use to earn profits. The most amazing thing about options is that you can start getting in on the action by only investing a small sum of money, even $100 or less. And each options contract gives you the right to control 100 shares of stock. Options sound complicated, but they are actually pretty simple. They were designed to give people the option to buy or sell off stock at a predetermined specific price. Options are contracts, and like all other contracts, they come with an expiration date. But the best thing about options is they trade on their own market, just like shares of stock. And when the stock prices change, so does the price of the options contracts. People trade options to profit off price moves on the stock market. That is, traders use the method of buying low and selling high to make profits from trades. You can buy options that expire at various dates in the future. Most of the action is centered on options that expire within a week to a month. But some options expire several weeks, months, and even years into the future. As we'll see, the expiration date for the option is something you'll need to pay close attention to. But for small investors, one of the best things about options is the high return on investment, or ROI. As we will see throughout the audiobook, a trader can earn far higher ROI trading options compared to stocks. So options trading is more accessible than day or swing trading stocks because of the low capital amounts required to get started. And you'll earn a much higher ROI. Well, I hope you are as excited about trading options as I am. Let's go ahead and get started. Note, the information provided in this audiobook is for educational purposes only and does not constitute financial, tax, or legal advice. Past performance is no guarantee of future success. If you are in doubt about your trades, please consult a professional financial advisor. Chapter 1. Options Trading Basics. An option is a contract based on 100 underlying shares of stock. Each contract fixes the price of the stock at a value called the strike price. Options also expire. They come with an expiration date, which is sometimes referred to as the expiry. There are two types of options. These are known as call options and put options. A call option gives the buyer the right to buy 100 shares of stock at the strike price. The contract is called an option because buying the shares is optional for the buyer. This is advantageous for the buyer if the market price of the stock rises above the strike price. That way they could save money by being able to get the shares at a discount. This is where an option gets its value. The higher the market price, the more valuable the option becomes. Of course, if the strike price is above the market price, a call option is not worth nearly as much. But if the share price rises, they will gain in value. A put option gives the buyer the right to sell 100 shares of stock at the strike price. So, a put option is a contract that gets its value from declining share prices. The way this works is that the investor buys a put option if they believe that future markets will decline. This fixes the price of the shares. If the prices drop by a large amount, they can buy the shares on the open market and then sell them to the originator of the options contract at the strike price. Since the strike price is higher than the market price, the investor has made a profit. Basic terminology in options trading. Derivatives. These are financial instruments or securities with a value that is derived from underlying assets. They are contracts between two or more parties where the underlying asset sets its value. Options are thus derivatives because the value is derived from an underlying asset. Options contract. This is a signed document between two parties, enabling potential transaction based on an underlying asset at a fixed price. Call option. This gives the buyer the right to purchase an underlying asset at a fixed price during an allocated time period. Buyers purchase this option with the possibility of the stocks increasing before the allocated time period expires. Put option. A put option allows the buyer to sell an underlying asset at a fixed price within a set time frame. You can liken it to holding a short position on stocks, wherein the buyers hope the value of the stocks will reduce before the expiration date. Long position. A long position is a type of directional strategy based on the increasing price of a particular stock. When the buyer purchases the stock, they believe that the price will increase, and they will then be able to see it as a higher price, therefore generating profit. Short position. This is another type of directional strategy where the buyer sells the stock they have borrowed. In doing so, the buyer hopes that the price of the stock will reduce, therefore allowing them to buy it at a lower price. In turn, they can then sell it to the broker who originally lent them the stock at a higher price, inducing a nice profit. Options market participants. There are 4 kinds of market participants. 1. Call option buyers. 2. Call option sellers. 3. Put option buyers. 4. Put option sellers. Investors who purchase options are called holders or buyers, while the ones on the sales end of the transaction are called writers or sellers. Call and put holders cannot buy or sell the underlying asset. All they can do is exercise their option. On the other hand, call and put writers are under an obligation to buy or sell, meaning they have to hold firm to what is set out in the contract. Strike price. This is the price the underlying asset can be purchased for. For call options, this is the rate that the underlying asset must go above before the stipulated expiration date in order for the option to be exercised. For put options, the strike price would be the rate that the underlying asset must go below before the stipulated expiry date in order for the investor to exercise the option. Expiration date. The last day an options contract is valid till. The right to buy or sell the underlying asset must be actioned before this date. Listed options. These are options that are traded on national options exchanges such as the Chicago Board Options Exchange, CBOE. In the money. Translated, this refers to the current market price of the underlying asset being above the strike price for call options and below the strike price for put options. Being in the money does not directly relate to profits, so it is vital to remember that buying options costs money and may not always be favorable. Premium. This is the complete cost of an option. Remember, it will take time to familiarize yourself with the options market jargon. You may have to undergo further research and study to fully understand what these terms mean in relation to options trading. Chapter 2. Profitability of options trading. Why trade options instead of the stock itself? As we'll learn later in this audiobook, options can be used in a variety of ways to take advantage and profit from the inherent rise and fall of the markets. Options offer an array of solid trading strategies, utilizing put and call options in abundant trade scenarios. I'll mention one strategy in this chapter to show you how options can be used with your current stock trading, but we'll go into greater detail in the strategy chapter. Options can be used to ensure your current holdings of stocks from a decline or increase, depending on if you are long or short. To explain the concept, you probably have insurance on your car or house against damage and loss of those assets. Options give the same type of safety net for stocks and investments. Options offer protection against a market price decline of the underlying stock or an increase in the market price of the underlying stock, depending on if you are holding it long, speculating an increase, or short, speculating a decrease. Options can facilitate a lower price stock purchase by exercising an in-the-money call option or sell a stock at a higher price by exercising an in-the-money put option. They can also provide an opportunity to create added income against a short or long stock position you are already holding. Here are some more reasons to start trading options whether you have a stock portfolio or not. Options allow you to trade all markets. No matter what the direction of the market is trending, up, down, or sideways, there's always a strategy to use for option profits. Options can be traded in any sector offering option contracts. Options have never been easier to trade. In the last chapter, you learned options have not always been readily available to everyone, and they have not always been easy to liquidate. In the past, people had to rely on newspapers and brokers to search for, find, and track their options trades, a system not always friendly to optimal profits. Today, you can place and track your trades online and sell in practically an instant for maximum profits. There are websites to keep you informed without having to call your broker for the latest affecting news. Websites like www.cboe.com or www.finance.yahoo.com list not only the stock's current price, but also the option's current price and any news affecting the underlying stock, all in a matter of minutes. Options let you start with surprisingly little money. This is one of the best benefits of trading options versus stocks. You don't have to so much money to start. You can open a brokerage account with a minimal amount of money. Minimum required amounts to open an account vary from broker to broker. Most brokers only require $1,000, and some no-frills brokers need less than $1,000. Few require more than $2,500, so do your shopping. You can trade options in a retirement account with no minimum balance requirements with some brokers. Options provide leverage safely. U.S. stocks are more expensive than ever before, and the large dollar investment required to participate in buying stocks really puts you and your money at the mercy of the market's constant churning, wreaking havoc on your portfolio and your emotions. Investors pay the price per share of the stock, whether it's $5, $100, or $1,000 per share. 100 shares of a $5 stock would be $500. But a stock costing $100 per share is $10,000, and a $1,000 per share stock is $100,000. Whereas options for the same stocks require 100 times less money for the right to control those shares. When the underlying stock prices rise or fall, the option prices rise and fall in relation to the stock price. This reaction can produce double or triple the money in profits. Options can easily double or triple your money. Options, as you will begin to learn in later chapters, offer versatility and a variety of ways to profit from rising and falling markets. You are using call options to profit from rising stocks and puts to profit from falling stocks. The best part is you can do it with far less money and double or triple your original investment without risking any more money than originally invested at the beginning. Options offer relief from high volatility in the markets and the uncertainty of traditional stock investing methods. Before we delve into option money-making strategies, let's first go over the basics by learning option trading terms you'll need to know and how options actually work so that you can trade them smartly. By knowing how options work and the terminology that's used, you will be better equipped to trade options profitably. Traders want to lose as little money as necessary and possible, and the less money you lose in this game, the more chances your portfolio will grow, and you will learn how to play it right. Losing a lot of money trading options in the beginning is more likely to compel you to quit before you learn how to play it correctly. Pay particular attention to the risk management chapter, and you will be rewarded with a deeply less concerning learning curve. Chapter 3. Call and Put Options. Calls. The above right for an option call buyer is the right to buy the asset. You would want to buy a call option if you were expecting the price of the underlying stock to rise. You would exercise your right before option expiration to purchase the underlying stock at the predetermined price, strike price. Or you could sell your right to another, like Thales of Miletus did. Two types of options trading grant two different rights. The first one is termed as call options. They give the buyer rights to purchase the asset that is underlying the contract on a later date, depending at a predetermined price. This right is, however, not obligatory, and is usually based on the discretion of the taker or the contract and his understanding of the market performance in the course of the life of the contract. The life of the contract refers to the period before the contract expires. The price of buying the contract is termed as the exercise price. Sometimes it is also referred to as the strike price. An example of call options is if Santos Limited has a contract available with shares on security that has the last sale price of $6. If the contract has a 3-month expiry period, the taker then has the option of offering the shares for a call of $6. One can buy 100 tokens of securities at the said call price per share at the time of choice for the taker in the course of the life of the contract. The taker is also required to pay premiums to the writer of the contract for the option. To fully own the call rights, one has to exercise it based on predetermined dates that are specified in the agreement. On the other hand, the writer of the contract has an obligation to ensure that the shares that are purchased are delivered. In the above example, the writer has to deliver 100 security token offerings as long as the taker of the contract has exercised the option. However, the writer sustains reception of option premium during the life of the contract, regardless of put, whether or not the taker exercises the option. Put. The option right for a put buyer is the right to sell the option. You would want to buy a sell option if you were expecting the price of an underlying stock to fall. You could exercise your right before option expiration and sell the shares at the predetermined price, strike price. We'll discuss later how this is actually done and used to pocket profits in the strategy chapter. Put options are designed to grant the taker rights of selling the underlying assets for a price that has been predetermined by the contract. The rights to sell have to be exercised in the course of the life of the contract. Just like call options, the taker of the contract is not compelled to exercise the right. In this case, the buyer only provides the shares required in the agreement if the put right is exercised. An example of a put option is when a contract by the writer has a predetermined $6 put token offering for a predetermined period of 3 months. The taker has a put option of selling 100 security token offerings as shares at the said price of $6 per share. This sell right has to be exercised in the active life of the contract by the date of the expiry of the agreement. As with call options, the taker still has to pay premiums to the writer for the contract and the trade to be valid. The right is only valid when it is exercised with the course of the life of the contract. Outside of it, the right is forfeited regardless of whether or not value was created out of the contract. This means that the taker of the contract has to be keen on market performance and judge well whether or not to invoke the sell rights and win. Sometimes, a taker will opt not to exercise the right of sell of shares as the contract expiry dies out. The exercise style is usually dependent on the system used. Two systems are usually used, the American style and the European style. The European style usually compels the taker to exercise the right in the contract only on the expiry date. The American style is more flexible and allows the exercise of the right any time before the date of the expiry of the agreement. Options pricing. So to understand how this works, you need to know how the pricing of options goes up and down. So, for right now, are focused on calls. In this case, what happens is, if the share price goes above the strike price for a call, the general rule is that the call is going to go up in value. If the strike price is above the share price and the share price is dropping in that case, the value of the call option is going to go down. The price of an option is also affected by the time left until the option expires. More time left, more value. You can buy options that expire at many different dates. Some are weeklies, meaning that they expire next week. You can also buy options that expire many weeks into the future or even months into the future, but they are more expensive. The reason they are more expensive is not only is there a long time before they expire, but looking at it another way, there's a lot of time left for the stock to move that could really change the value of the option. Then the share price is higher than the strike price of a call option. They say it in the money. When the share price is equal to the strike price, it's at the money. If the share price is below the strike price for a call option, it's out of the money. What you need to remember is the closer the option gets to the expiration date, the more its price decays. There is a tug of war between the time decay of the price and the share price. So, at the same time, if the price of the shares, in the case of a call option, is rising above the strike price, then the price is going to be rising. For this level of the audiobook, we're not going to get into the actual formulas, but there are ways to predict the actual price. But a general rule of thumb you can keep in mind is that $1 rises in the share price is going to lead to a $100 rise in the value of the option. That's because each share goes up $1, and it's 100 shares for the option. Be advised this is far from exact, but it's a reasonable rule of thumb to understand what's going on. You can buy a more advanced treatment of focuses only on options to learn what the real formulas are and how they work. Also, if you get online, you can find spreadsheets that will do the calculations for you, and the predicted prices are very accurate. There is a parameter you need to know if you want a more accurate estimate of price changes, which is called delta. Delta is something you can read on the stock info about the option provided on sites like Yahoo Finance. What it tells you is a more accurate estimate of what the change in the option price is going to be for every dollar change in the share price. So, if delta is 0.6 and the share price rises by $1, then the price of the option on a per share basis is going to raise 60 cents. That means the total price of the option would rise by $60. The value of the option that comes from the underlying stock is known as the intrinsic value. The value of the option that comes from time left to expiration is called extrinsic value. At a certain point, that will totally lose value. Compare two options. An option that has a longer time to expiration but the same strike price as another option will be worth more money. Let's look at that for American Express. I quoted you an option that expires in a week for $118 and was $1.02 per share. But if I took 3 weeks out, an option with the same strike price costs twice as much money. The listed price is $2.05 per share. That reflects the fact that with 3 weeks left until expiration, that option will be around long enough to take advantage of any volatility in the price of American Express stock before it reaches the expiration date. But of course, there's a balance. At some point, the time value is going to be decaying enough that it takes a lot of value away. So you have a sense of when the best time is to buy and sell options. When you are trading options, you need to stay on top of it very closely. I have found that in a matter of hours, the money I invested has doubled. So, if I had been paying attention, I wouldn't have been able to sell them and take advantage of the profits. In other cases, option prices can drop quite fast as well. So, if you remember our discussion from day trading, one of the things you want to do as you stop loss orders. Chapter 4. Financial Leverage and Options Trading. Trading options using leverage is usually considered riskier because it exaggerates the potential of the business. For instance, you can use $500 to enter a trade that has a potential of $7,000. Remember the first rule of trading: don't trade what you cannot lose. This isn't as true as it seems, which is why you must know what you are doing at all times. Leverage makes you utilize capital more efficiently. For this reason, many traders love the trade because it allows them to go for larger positions with limited capital. When you use leverage, you don't reduce the potential profit that you will gain. Rather, you reduce the risk in certain trades. For instance, if you want to put your money in 10,000 options at $8 per share, you would need to risk $80,000 worth of investment. That means the whole amount of $80,000 would be at risk. However, you can use leverage to place a smaller amount of money, thus reducing the risk of loss. This is the way you need to look at leverage, which is the right way. Before you can trade leverage, you need to find a way to maximize the gains in each trade. Here are a few tips that you can explore. Know when to run. You need to cut losses early enough and then let your winning trades run to completion. Just the way you run other trades, you need to know when to cut your losses so that you don't end up bankrupt. You need to make use of stop losses when running leverage in trades. Have a stop loss set. As a trader, you need to determine your stop loss set so that you don't lose more than you can afford. The set that you come up with will depend on the situation of the market at any time. Whatever the case, always make sure you have a set to guide you. Don't go with the trade. Many traders try to chase a trade to the finish. Sometimes that ends up discouraging them and making them lose money. Once a move happens, you need to accept and wait for the next opening. Always be patient, because just like the other opportunity came along, another one will definitely come by. Have limit orders. Instead of placing market limits, opt for limit orders instead so that you can save on fees. The limit orders also help you rein in your emotions when you trade. Learn about technical analysis. Make sure you learn about technical analysis before you jump into trading. Technical analysis will make sure that you have the information that you need to make decisions fast. The advantages. When you use leverage, you increase your financial capability as a trader and enjoy better trading results. You can change the amount of leverage at your discretion. This is because when you open a trading account, you have all the power of managing the amount of capital that you place on a trade. The good news is that you can use leverage free of charge, but you need to make sure you know how it works and whether it will work for you or not. The level of leverage varies. Some trading platforms offer leverage as low as 1-to-1, up to and beyond 1-to-1,000. As a trader, you should go for the largest leverage possible so that you can make the biggest returns. Another advantage is that low leverage allows you as a new trader to survive. When starting out in options trading, you can make small trades with little to show for your efforts. With leverage, you can make use of leverage to place trades that run into thousands of dollars without risking the same amount in terms of investment. As long as you know what you are doing, you have the capability to enjoy massive profits. The disadvantages. As much as it is a good way to make huge profits, you also need to understand that leverage comes with many demerits. These include: magnifies the losses. With leverage, you will be faced with huge losses if the trade decides to go the other way. And since the original outlay is way smaller than what you end up losing, many traders forget that they are placing their capital at risk. Make sure you come up with a ratio that will help protect your interests and then know how to manage trade risks. No privileges. When you use leverage to trade, you sacrifice full ownership of the asset. For instance, when you leverage, you give up the opportunity of enjoying dividends. This is because the amount on the dividend is deducted from the account regardless of the position of the trade. Margin calls. A margin call is when the lender asks you to add functions so that you keep the trade open. You have to decide whether you wish to add funds or exit a position to reduce exposure. Incur expenses. When you use leverage to trade options, you will receive the money from the lender so that you can use the full position. Most traders opt to keep their positions open overnight, which attracts a fee to cover the costs. Leverage needed in option trading. Knowing how to trade options needs detailed knowledge about the various aspects of economics. For many people, the lack of knowledge to use leverage is the major cause of losses. Studies show that many traders who opt for options lose money in the process. This happens whether for smaller or high leverage. Risks of high leverage. In options trading, the capital for placing a trade is usually sourced from a broker. While you have the ability to borrow huge amounts to place on a trade, you can gain more if the trade is successful. A few years back, traders were able to offer leverages of up to 400 times the initial capital. However, rules and regulations have been, and at the moment you can only access 50 times what you have. For instance, if you have $1,000, you can control up to $50,000. Choosing the right leverage. You need to look at different factors when choosing the kind of leverage that will work for you. First, you need to start with low levels of leverage because the more you borrow, the more you will need to pay back. Second, you need to use stops to make sure you protect the amount you have borrowed. Remember, losses won't go down well with you. All in all, you need to choose leverage which you find is comfortable for you. If you are a beginner, go for low leverage so that you minimize risks. If you know what you are doing, then go for maximum leverage to build your returns. Using stops on order allows you to reduce losses when the trade changes direction. As a newbie, this is the only protection you need to make it in the market. This is because you will learn about the trades and how to place them while limiting any losses that might arise. Chapter 5. Warning: Options Risks. Options trading comes with a number of risks that you need to manage so that you can enjoy the profits and minimize the losses. Here are a few risks and how to deal with them. Losing more than what you have. This risk is inherent in options trading, especially if you are using a leverage to make a trade. It means that you put up a small fraction of the initial deposit to open the trade. This means that your fate is in the hands of the direction of the market. If it goes along with your prediction, you will gain more than the deposit. On the other hand, if the direction changes and you lose the position, you might end up losing more than your initial deposit. When this happens, you need to have a strategy in place to help mitigate the risk. What you need to do in this case is to set a limit, so that you define the exact level at which the trade should stop, so that you don't lose more than you can handle. Positions closing unexpectedly. When positions close unexpectedly, they lead to loss of money. To keep the trades open, you need to have some money in the account. This aspect is called the margin. And if you don't have enough funds to cover the margin, then the position might close. To mitigate this, you need to keep an eye on the running balances and always add funds as needed. Sudden huge losses or gains. The market can turn out to be volatile, and when it does, you need to move fast. Markets change depending on the news or something else in the market, which can be an announcement, event, or changes in trader behavior. Apart from having stops, you also need to get notifications regarding any upcoming movement, which tells you whether to react or not. Orders filled in erroneously. When you give instructions to a broker to place a trade for you, and the broker instead does the opposite. This is termed slippage. When this happens, use guaranteed stops to make sure you protect yourself against any slippage that might occur. Chapter 6. trading strategies for calls and puts. Strategies related to calls. The process of buying and selling of calls is one of the easiest in the options trading field. It is actually one of the popular and frequently used ways to get into options trading. This is because it allows you to own stock using very little capital. Buying calls also presents you with a higher profit potential than purchasing stock. Some of the strategies you can exploit when buying calls are listed below. Covered calls. Covered calls entails setting up call options against your own stock. This strategy is not only popular in options trading, but in other financial institutes that deal with stock as well. In this strategy, you only sell options to protect your stock from a downward price movement and also increase your returns. Most investors do this anytime there is a possibility of good gains on their stock. In most cases, they sell out of the money calls, and once the price goes high, they trade the stock for a profit. One advantage of this strategy is that you get to keep your stock at expiration if it falls below the strike price. If the stock goes above the strike price, you will sell the stock shares to the buyer at the strike price. Most investors use this strategy to generate profit at limited risks while retaining their stock. The downside of covered calls is that you need at least 100 shares of stock to make the calls. The strategy is thus not beneficial for traders who start small. Traders are also allowed to sell only one call option against 100 stock shares. This is called a covered call because in the event that the stock price goes high, the call will be covered by the position of your stock. You can consider using this strategy to make a profit if you already have the required stock and do not expect its cost to go high in the near future. Bull call spread. In this strategy, you purchase calls continuously and at specific strike prices, then sell these calls at higher strike prices. Normally, the calls have the same expiration time and are related to the same underlying security. Investors use this strategy when there is an expected rise in the cost of the underlying asset, especially during high volatile periods. When used correctly, it reduces the trader's upside and lowers the premium spent as compared to buying covered calls. This strategy lowers the cost of a call option and defines a limit within which the investor can generate income. Here's the procedure of applying the bull call spread strategy. Select an asset that has the potential to appreciate in days, weeks, or months. Purchase a call option at a strike price that is higher than the current market price. Specify the expiration date and make payment for the premium. Select a call option at a price that is higher than the strike price, but with the same expiration date as the initial call option. Do this simultaneously until the expiration time is reached. By simultaneously selling call options, you will be able to receive a profit that will offset what you paid for the long or first call. Since the strategy operates within limits, profits and losses are often constrained to certain amounts. This eliminates the possibility of losing all your stock in the trade. However, the disadvantage of this is that you cannot obtain any gain that is beyond the strike price of the sold call options. Long call. This strategy allows you to buy a call while expecting the prices to go beyond the strike price during expiration. One great advantage of this strategy is that if the prices go higher than the striking price, you can earn multiple times the initial premium, since the trade has no upper limit. As the stock rises, the call keeps going higher. It is for this particular reason that long calls are common amongst traders who wish to make a profit from rising stock prices. A disadvantage of this strategy is that if the expiration is reached and your stock is below the strike price, you may lose your entire premium. Therefore, use this strategy only when you are sure that the costs will keep rising until the option expires. If the stock rises only by a small percentage, you may lose part of the premium. Long call butterfly spread. This strategy combines the bull spread strategy and the bear spread strategy. These two strategies converge at the same strike price. Therefore, the long call butterfly strategy makes use of 3 strike prices. Just like the bull call spread, this strategy requires that you use call options derived from the same asset and having the same expiration date. Because the strategy allows you to sell 2 options at the same strike price, it is considered one of the low-price strategies that beginners can take advantage of. However, since it utilizes spread of long and short calls, the chances of getting large profits are relatively slim. If the strike price is higher than the premium, the trade is considered to be bullish. And if it is lower than the premium, it is a bearish trade. Short call. In the short call strategy, you are required to sell your stock at a certain striking price assigned to the option. The main target of this strategy is for the call to expire worthlessly. The stock price must remain below the strike price for you to realize a profit. You risk losing your premium if the stock rises. Most traders only use this strategy when there is a high probability that the stock price will diminish. The more it rises, the more you lose money. Related to this is the short call butterfly spread that involves selling 1 call option at low striking prices, buying 2 at-the-money call options, and then selling 1 out-of-the-money call option with a higher strike price. Profit is realized when the underlying stock's price rises over the higher striking price or goes below the lower strike price during expiration. Strategies related to puts. Buying of puts is one strategy that you should use anytime you notice the market taking a direction that is against your call options. Traders buy puts whenever there is a possibility of the prices going down. Buying puts the opposite of buying calls. Here are some strategies related to put options that may be of benefit. Cash secured puts. This is the opposite of covered calls. This strategy requires you to sell puts against a liquid cash balance in your broker account. The only people who use this strategy are investors anticipating a decline in the stock price or those traders who wish to generate some profit from excess cash that is in their possession. Through selling puts against their cash, they are able to make some profit. Generally, this strategy involves selling put options while saving enough cash to the side to purchase the underlying stock. It allows you to get stock options at discounted prices and sell them at profit. The goal is to acquire the underlying stock at a price that is below the market price. When the stock goes below the strike price, the put is assigned and the trader allowed to buy the stock at the strike price. The process involves a lot of risks, since the stock may decrease way below the strike price, and this means that you may be required to purchase the shares at an amount that is above the current stock price. This comes as a loss to you, especially if the strike prices keep going down. Married put. This is where an investor buys stock and equivalent put options simultaneously. You can sell the put option at the strike price, just like the covered call. Each married put contract requires 100 shares. In this case, the trader is positive that the stock value will rise, but uses a put option as insurance should the value go down. The married put strategy is common in investors who have a vision of minimizing the downside risk of their stock. When an investor buys the shares and an option, he protects his stock from loss should a negative event occur, and also makes some cash as the stock's value increases. However, if the stock does not go down, the investor loses the cash placed on the put option as a premium. The married put has so many similarities with the covered call. It gets its name from combining or marrying a put option with the underlying stock. For every 100 shares, you are only allowed to buy 1 put option. The maximum profit for this strategy is undefined. The more the stock appreciates, the higher the profits. One downside of this strategy lies in the cost of premiums. The put option increases in value as the stock value declines. Because of this, the trader loses the cost placed on the option. Such losses, however, cannot be compared to the value of the underlying stock, which would have been saved in the process. Long put. Here, the trader purchases a put while expecting the prices to go below the strike price at expiration. It allows you to multiply your initial investments in case the stock value falls at zero. The long put has various similarities to the long call. The only difference is that you are expecting the prices to decline rather than go up. The upside of the long put is similar to that of the long call because the put option's value is capable of increasing in bounds. However, in this case, the stock should not go on the upside. This strategy helps minimize the risk involved in shorting of stock. You must, however, note that if expiration is reached when the stock is above the strike price, the put option will be worthless and you will gain no profit. The long put strategy is ideal for use when you expect the stock price to fall before the expiration of the put option. The fall must be significant for you to return to the premium paid, otherwise you will end at a loss. Short put. Similar to the long put, the short put strategy is where you sell a put with the expectation that the price will rise above the strike price by the end of the trading period. In this strategy, you receive cash as a premium for selling a put. If the stock is below the strike price by expiration, you will be forced to purchase the underlying asset at the strike price. The strategy is also known as the naked or uncovered put and gives an investor the right to purchase shares of an underlying stock when a put option buyer exercises the option. For you to initiate a put option using this strategy, you have to be sure that the cost of an underlying asset will remain above the striking price. If the option expires worthless, you risk losing part of your initial investment. One downside of this strategy is that the profit is limited by the premium received, and there is a significant amount of risk involved. You should, therefore, use it only when they are positive that the stock will go up. You must also ensure that there is enough equity in your account to purchase the underlying stock should the put options work against your expectations. Bear put spread. This is one of the best strategies for beginners since it involves short put spreads. The bear put spread can be easily applied to small and new trading accounts. It does not have any restrictions in terms of shares or premiums. It is also known as the short put spread and involves the selling of puts. You can use this strategy when expecting the stock to remain at the same value or increase in price until the expiration date. If this happens, the option will expire worthlessly, and you will get your whole premium back. To set up the bear put spread, start by selling a put option. Then purchase another put option with a lower strike price than the one you sold. The option you buy should have the same value and expiration date as the one you sold. This makes your sold put more expensive than the one you bought, translating into some profit. Unlike the long call, which returns multiple times of the investment, the short put spread can only give you a maximum return that is equal to your initial premium. This amount will be determined by the direction of the market. If the stock remains at the same level or goes beyond the strike price, you will get your premium back. If the stock decreases below the strike price, you will be forced to purchase the underlying stock at the strike price, and this results in a loss. Investors use this vertical spread strategy to make a profit from selling premiums to other investors, who have bet against the stock prices going up. Because put sellers often have a certain number of shares to their name, they cannot get stuck when it comes to paying out on losses. In case you need to use this strategy, you must be careful that you do not sell your puts without first understanding the market. This is because stock prices may fall and claim all your premiums. Chapter 7. Common Mistakes Made by Beginner Traders. Trading options are more involved than trading stocks, so there are ample opportunities to make mistakes. It's important to take the approach of going small and slow at first so that you don't lose the shirt off your back. That said, if you run into mistakes, don't get too down about it. Dust yourself off and get up to fight another day. With that said, let's have a look at some common mistakes and how to avoid them. Putting all your eggs in one basket. While there is a difference between investing and trading, as traders can learn a few things from our investor brothers, and most people have a little of both anyway, don't let everything ride on one trade. If you take all the money you have and invest it in buying options for one stock, you're making a big mistake. Doing that is very risky, and as a beginner trader, you're going to want to mitigate your risk as much as possible. Betting on one stock may pay off sometimes, but more times than not, it's going to lead you into bankruptcy territory. Investing more than you can. It's easy to get excited about options trading. The chance to make fast money and the requirements that you analyze the market can be very enticing. Oftentimes, that leads people into getting more excited than they should. A good rule to follow with investing is to make sure that you're setting aside enough money to cover living expenses every month, with a security fund for emergencies. Don't bet the farm on some sure thing by convincing yourself that you'll be able to make back twice as much money and so cover your expenses. Things don't always work out. Going all in before you're ready. Another mistake is failing to take the time to learn options trading in real time. Just like getting overly excited can cause people to bet too much money or put all their money on one stock. Some people are impatient and don't want to take the time to learn the options market by selling covered calls. It's best to start with covered calls and then move slowly to small deals, buying call options. Leave put options until you've gained some experience. Failure to study the markets. Remember, you need to be truly educated to make good options trades. That means you'll need to know a lot about the companies that you're either trying to profit from or that you're shorting. Options trading isn't possible without some level of guesswork. But make your guesses educated guesses, and don't rely too much on hunches. Not getting enough time value. Oftentimes, whether you're trading puts or calls, the time value is important. A stock may need an adequate window of time in order to beat the stock price, whether it's going above it or plunging below it. When you're starting out and don't know the markets as well as a seasoned trader, you should stick to options you can buy that have a longer time period before expiring. Not having adequate liquidity. Sometimes beginning investors overestimate their ability to play the options markets. Remember that if you buy an option, to make it work for you, you're going to need money on hand to buy stocks when the iron is hot. And if you're going to need to buy 100 shares for every option contract. Before entering into the contract, make sure that you're going to be able to exercise your option. Not having a grip on volatility. If you don't understand volatility and its relation to premium pricing, you may end up making bad trades. Failing to have a plan. Trading seems exciting, and when you're trading, you may lose the investor's mentality. However, traders need to have a strategic plan as much as investors do. Before trading, make sure that you have everything in place, including knowing what your goals are for the trades. Having pre-planned exit strategies. Developing criteria for getting into a trade so that you're not doing on a whim or based on emotion. Ignoring expiration dates. It sounds crazy, but many beginners don't keep track of the expiration date. Would you hate to see a stock go up in price and then hope it keeps going up, and it does, only to find out that your expiration date passed before you exercised your option? Over-leveraging. It's easy to spend huge amounts of money in small increments. This is true when it comes to trading options. Since stocks are more expensive, it's possible to get seduced by purchasing low-priced options. After all, options are available at a fraction of the cost that is required to buy stocks, and you might keep on purchasing them until you're over-leveraged. Buying cheap options. In many cases, Buying cheap things isn't a good strategy. If you're buying a used car, while you might occasionally find a great car that is a good buy, in most cases, a car is cheap for a reason. The same applies to options trading. When it comes to options, a cheap premium probably denotes the option is out of the money. Sure, you might save some money on a cheap premium, but when the expiration date comes, you might see the real reason the option contract was a cheap buy. Of course, as we described earlier, there may be cases where cheap options can rebound and become profitable by the time the expiry date arrives. But taking chances like that is best left to experienced traders. Giving in to panic. Remember that you have the right to buy or sell a stock if you've purchased an option. Some beginners panic and exercise their right far too early. This can happen because of fears that they'll be missing out on an opportunity with a call option, or because of fears that a stock won't keep going down on a put, not knowing how much cash you can afford to lose. Going into options trading blindly is not a smart move. With each option trade you make, you need to have a clear idea of how much cash you have on hand to cover losses and exercising your options. You'll want to know how much cash you can afford to lose if things go south. Jumping into puts without enough experience and cash to cover losses. Remember, if you're selling puts, you will have to buy the stock at the strike price if the buyer exercises their option. This is a huge risk. The stock could have plunged in value, and you're going to have to buy the stock at the strike price, possibly leaving you with huge losses. Don't go into selling puts with your eyes closed. In fact, beginners are better off avoiding selling puts. But if you do it, make sure you can absorb the losses when you bet wrong. Piling it on. Most beginner mistakes are related to panic. If you're looking at losses in options, some beginners double and triple up, hoping to make it up when things turn better. Instead, they end up losing more money. Instead of giving in to panic, learn when to cut your losses and reevaluate your trading strategy. Staying in a written contract when you should get out. If you've sold an option and it's looking like you might face a loss, you can always get out of it by selling. Conclusion. Options trading is such a unique yet valuable way of making money in the stock market. While there are some risks involved in the trade, these are normally limited, giving you a chance to make some good money from the trade. Adequate market research and knowing when to make a move will help you succeed in options trading. Brokers can also assist too, since they can help you trade before you master the business. After reading this audiobook, you must have figured out how easy options trading is. With the information covered here, plus your desire to make it in options trading, you have no option but to excel in the business. You are now better prepared to trade options using fundamental analysis and other procedures. You are also ready to take opportunities as they come and have a sense of what each trade entails from a trader view. Trading in options is a process. The more prepared you are, the better the experience. Of course, the starting point lies in understanding what options trading is. Options are an alternative strategy for Forex investors who do not wish to trade in underlying securities. The basics involve understanding how to purchase and sell calls and puts. This is what constitutes an options contract. Let us recap a few points from this. An option refers to a contract that gives a buyer the authority to buy or sell an asset at a certain price within a certain period. Options do not represent the real value of an asset or underlying security. An option in itself is a derivative of an asset or a security. Calls give you the right to purchase an asset, while puts allow you to sell an asset. The options market has 4 participants. These are the buyer of a call, the buyer of a put, the seller of a call, and the seller of a put. The cost of an option is referred to as the premium. Long-term options are known as leaps. With basic information at hand, you are now ready to attempt your first trade. The power of options lies in their versatility. However, this versatility comes with a cost. If not handled carefully, the trade becomes riskier than stock. That is why you will come across many disclaimers advising you to only engage in options trading using risk capital. Thank you. I would like to thank you from the bottom of my heart for coming along with me on this options trading journey. There are many audiobooks out there, but you decided to give this one a chance. If you expanded your knowledge by listening to this book, then I need your help. Please take a moment to leave an honest review of this audiobook. This feedback gives me a better understanding of the kinds of audiobooks and topics listeners like yourself want to know more about. It also gives my audiobook more visibility to potential new listeners. Leaving a review takes less than 1 minute and is appreciated. Other titles by Giovanni Richters. Ever have a feeling that you never have enough money when needed? Would you like to have some extra cash to buy what you feel like? Well, in this book, we look at 50 different tips allowing you to have some extra cash in your pocket and bank account. Smart investors create wealth. It's never too early to start your journey toward accumulating wealth. No one wants to work for the rest of their life. I will show you what wealthy people have known for centuries on how to not only create wealth, but also maintain it so you can pass it down. Important disclaimer. Please note that the information contained within this document is for educational and entertainment purposes only. Every attempt has been made to provide accurate, up-to-date, and reliable information. No warranties of any kind are expressed or implied. Readers acknowledge that the author is not engaging the rendering of legal, financial, medical, or professional advice. The content of this book has been derived from various sources. Please consult a licensed professional before attempting any techniques outlined in this audiobook. By reading this document, the reader agrees that under no circumstances is the author responsible for any losses, direct or indirect, that are incurred as a result of the use of the information contained within this document, including, but not limited to, errors, omissions, or inaccuracies. This has been Options Trading for Beginners and Dummies, written by Giovanni Richters, narrated by Christopher C. Kelly. Copyright 2019 by Giovanni Richters. Production copyright by Giovanni Richters.